Okay, here's a quick recap of the first lien HELOC in comparison to your existing mortgage, which is a 30-year fixed. We said approximately 7%, about 28 years left to go, somewhere around 173,000, with mortgage payment probably somewhere around 14 to 1600, somewhere in that range. So we're going to look at first a starting point of replacing your existing mortgage with average income coming in, average expenses going out, and then we'll also see what happens when we add the car loan as well. Sounded about maybe about a car loan of 17,000 with under $400 payment. So side by side, we're going to see we have about 6,500 of income coming in through the various sources. On average, we have about 3,000 of expenses going out. We replaced this mortgage, so over here we're looking at the 3,000 being the remaining household expenses. We're accounting for the taxes, the property taxes. They will be non-escrowed, and then over here we're accounting for the HOA and insurance that's on the property as well too. So as we scroll down, the way this works is we're going to open up a checking account. It's attached to the line of credit. So when the dollars come in, they're automatically going to move over, decrease the balance of the line of credit. When the expenses go out, it's going to add back to the balance. We then calculate the interest based upon the daily average balance. So how many days did we hold it at the lowest point before we increased? A lot of times we're probably going to use a credit card for the majority of these expenses paid off at the end of the month. So if we have this ratio of about $2 in, $1 out, that scenario would pay off the mortgage in about 5.75 years, 43,000 of interest versus 222,000 that's on your projected mortgage. So right now you owe 173, but you actually have more interest than what your balance is. So we're flipping that around just based upon how we move our money in and out through the line of credit. So again, 5.75 years, about 43,000. So if we took out a $173,000 loan, if a bank gave you a 30-year loan with 43,000 of interest, it would be equivalent to having a 1.55%. As we do pay down, we also retain access to these dollars, so we can draw these funds back out, layer it in for additional investment purposes or paying off other debt, such as paying off the car loan. If we paid that car loan off, now we owe 190,000, but our expenses went down to 2,600, just average down to 400. So now we owe 190. We have 6,500 coming in, 2,600 to go out. We pay off in 5.5 years, and we can see how long did it take to pay off the auto loan. That was paid off in about 7 years. So the line of credit is going to be available up to about 85% of your appraised value. So we estimated that could be close to 220. So if you did pull out the full 220, still have this amount coming in, that amount going out, at that rate, we'd pay off in under 7 years. So this whole strategy is all dependent upon what's our loan amount, what's our income, what are our expenses. It also allows us to retain access to the liquidity. So as we pay this down, we can always draw it back up to the 220 balance. We have a 10-year draw. So those are some of the details and comparisons of how the first lien HELOC works versus your existing loan. We'll put together an email summary and additional answers or questions and answers. We can jump on a call and continue to review. Thanks.